Caller who happens to be David from Canberra. Welcome to the program, David.
G'day fellas, how you going?
Not bad, mate. What can we do for you?
I just had a question about carsales.com.
Yeah.
I was just wondering what you think of that. I think its return on equity is sort of over 50%. I was just wondering if you think the PE ratio is too high.
Interesting question. The short answer to that is yes, the PE ratio is high on it, but again, this comes back to this this point we were making earlier that the market is paying high multiples for these growth stocks, and I think it must be up around car sales must be around 24, 25 times, something like that at the moment.
Yeah.
But it did deliver a good result.
Yeah.
And it is expanding overseas again. Following the model like Seek, and it's going into Latino countries, made an acquisition in Brazil.
Yes.
So if there is a successful build out, then possibly this multiple is justified, but to my way of thinking, it's still way too high.
Well, we would agree with you, Kim. I mean, look, this is a superb business. We would rate this as an A1 business. It's got a very, very strong balance sheet. It's, as you said, David, in the call, the ROEs are around 60 percentage points, which is, fantastic. It's a stock that's capitalised at about $2.7 billion, so it's got all the right attributes. However, there is one missing attribute for us, and that is value. And the current share price is about $11.30, and we would value this stock at around about $9 round figures. So we would say that it's maybe somewhere around about 20% too expensive, but it's a great business. It gets a great rating. It's got a great ROE. It's got a great balance sheet. It's got great prospects. It's just a little too expensive.
I never thought we'd agree on something. There you go. The break is Ian from Mildura. Welcome to the program, Ian.
Yeah, g'day Kim, how you going?
Good, mate. Yourself?
Good, thanks. That ad break just gave me a chance to have a bit more red wine. But the seller's getting a bit low, so I need to make a decision on Woodside or Metcash. Which would you be in? Why and why not? Thanks.
All right. Well, we had the Woodside report today. I'm just trying to put my finger on the actual result, and it did look. Here we go. It stumped up a good first half net profit of US $873 million, 22% increase in production, which looked pretty good. And of course, we've got the special dividend coming through to 83 cents. The balance sheet looks very, very strong with net debt at $2.2 billion and undrawn facilities of about $3.4 billion, and some good projects still on the drawing board to be developed, like the Brown Space. And so, to my way of thinking, Woodside falls into that category where it's a resource stock which you buy for the dividend yield. which you're probably going to severely disagree with.
No, look, I'm not actually. We would say that Woodies are selling at a bit of a discount to their valuation. They're obviously a high quality stock. They don't have a lot of indebtedness. They are obviously on the Browse joint venture. They're talking to their partners, and they're talking about this Shell floating platform proposition. That'll be about a $40 billion spend. A decision will be made on that in about the next 2 years, so they obviously will have to raise a certain amount of indebtedness to fund that JV.
Well, as we're saying, that the balance sheet's very, very conservatively geared.
Yeah,
so
and their debt has actually come down pretty aggressively lately in readiness for this decision. But I think what's happened is that they used to have to attack Browse from, I think it's James Price Point. But now what they've decided is that they can actually attack it from this new technology that Shell have introduced.
Which is a hell of a lot cheaper and a hell of a lot more efficient.
And I think that's one of the reasons. I think it's one of the Chinese organisations have joined the consortium, possibly China Petroleum or some organisation like that. And I think they're pretty positive on the prospects. So I would say just the way that Woodies are talking, there's a better than even chance that'll be a go-ahead decision, but it will obviously cost a huge amount of money to get that up and running, which, as I say, the decision will be made in the next 24 months. Now, on Metcash, very like Woodies, the valuation for us is slightly above the prevailing share price. The prospects in an environment where you've got this sort of duopoly, are probably, a little less exciting, but they're clearly a pretty well-run business in the context of a massive duopoly against you.
Well, given the fact that we've got Woolworths and Wesfarmers trading again at fairly high multiples for defensives at sort of 16, 17 times.
Yeah.
Where's Metcash?
Well,
sit
just
against that
let
metric?
Let me just get that, Kim.
Because one of the things I've been saying is that Woolworths to us looks very, very expensive in the sense that they've got these problems with masters, which we've spoken about, long and deep, and Wesfarmers is actually attacking Woolworths. Woolworths EBIT margin. Of course, we've got Aldi and Costco coming into the market, so competition's increasing.
Yeah. Look,
so it's sort of like an interesting set of dynamics. So
yeah. So we've got Metcash, $3.1 billion business. PE's about 11 times, so that's not sort of onerous. Return on equity is about 18%. Net debt to shareholders' funds about 47 percentage points. So not too bad. We would classify this as a B3, so I'd just get into our investment universe. And as I say, the share price is probably slightly less than the valuation, but not dramatically. But I would say that you're up against these gorillas, and you're up against some new competition from offshore. So I'd just be a bit wary of that one.
Well, yeah, and I guess that's why the market's only got on a multiple of 11.
That's right.
11 times.
That's right.
Okay. All right, now for a viewer email, and Taryn writes, "Hi, I'm looking at purchasing some IAG shares. What are your thoughts on this stock? Would you prefer QBE over IAG in this space?" Okay, insurance stocks. Well, QBE's reported. Market didn't seem to like it all that much, but I thought it wasn't a bad result. What was your take?
Yeah,
on it?
what I think is very interesting about QBE is it in fact has through its business model quite a close what do I call it, correlation to US bond yields.
Yeah.
And what we've seen in the last 13 months is US bond yields have popped pretty aggressively. Their 10-year bonds have popped from roughly 1.4% towards 3 percentage points.
Well, 3% last night.
Yeah, so it's been a very, very aggressive sell-off. I mean, it only sounds like 1.5% rise, but it's from 1.4 to close to 3. But it's been a very, very aggressive sell-off, and we think that over time that will filter through into the QBE business model quite nicely. And what we obviously saw is a result of still some cleaning up from some, several acquisitions still to come through. Share price got thumped on its result. But we would say that over the medium term, this could be quite an interesting opportunity, and we would value QBE at maybe closer to $17.
The interesting thing was the market was disappointed in the fact that insurance premiums haven't been rising as quickly as has been suggested. Now, have you got any particular reason why you think that's been occurring, or is it company specific to QBE, or is it more of an industry-wide trend?
I think that would be specific to QBE, but what I would say is that with the rising bond yields, with a lot of general insurers, they try and make sure that they don't lose too much money, and then they try and make a lot of money on their investment portfolio, and that's really how they work. And I think with the rising bond yields, their investment portfolio should actually give them a much greater return over the medium term.
What about IAG? What are your thoughts on that?
Oh, we would prefer QBE, to be honest with you.
I was going to say, what about Suncorp? Because we saw that result today, and that was
Yeah.
a core profit up 19%. The interesting thing there, the general insurance net profit was $883 million, which was an increase of 8% in gross written premium, which compared with QBE's 2%. So there's particular strength as far as Suncorp says in the personal insurance business.
Yeah, our problem with Suncorp is just simply the valuation. We have a valuation that's considerably less than its prevailing share price.
Okay, so when we're looking at QBE, how much of that valuation have you got in terms of that valuation? Have you got FX built into that? No,
our valuation will be just sort of based on reasonably normal conditions, and so that's $17. We would just say that if things return to sort of normalcy for a business like that, then $17 is absolutely achievable.
Okay,
and more if they can get good growth.
And so, okay, at these sorts of prices, the valuation $17. Where would if you look at it 12, 18 months down the track, where would you expect it to be? Any ideas?
Oh, look, Kim, it depends a lot on its prospects. That's the real answer, and it's a very sort of complicated black box insurance company. So it depends a lot on, as you say, the growth in premiums, the price of premiums, and the return they get on their investment portfolio. So it's quite complicated. So what you've got to try and do is just take a medium-term view for each of those factors.
And what are your thoughts on the management of QBE? I mean, we looked at QBE and we looked at Suncorp, and we thought Suncorp had better line management in the insurance business than QBE.
Look, you're probably right, but for us it's about the valuation, and just from our point of view, the Suncorp valuation is just it's a lot less than the share price.
Okay, now we've got about a minute to go very quickly. I just want to get your take on what you thought that NAB's result was. That update for the third quarter.
Yeah.
What did you quickly think of that?
Well, NAB's been an appalling share to own for 10 years. Its share price is approximately where it was a decade ago, but finally, I think for the first time in a decade, all the cock-ups of the UK and the US acquisitions seem to be suddenly becoming less meaningful, and I think that the prospects for the first time in 10 years suddenly look as though they're just looking a tiny bit better.